Welcome everyone, and thank you for joining today's Prime Wellness webinar. As you already know, we're going to be discussing a very hot topic today, and it's going to be centered around an election year. And we get a lot of different questions as it relates to what are some of the different things that someone might need to do during an election year in terms of their investment strategy and really their overall financial planning. And so what we've tried to do today is take some of the most frequently asked questions that we get and put that into today's webinar to try to help all of you as you're kind of getting information and as you're watching the news and different things like that that are going on, that you can kind of navigate through that information ultimately so that you feel good about where you're at and what you're doing, really regardless of what happens with this year's election. My name is Kyle Bingham, and I'm the Managing Director for Prime Capital Wellness. And joining me today is Josh Zeb. He is one of our financial education consultants. And here's a look at those questions that we'd really like to focus on today. We'll start off by talking a little bit about and answer the question, how does the election affect the stock market? Then we'll move into how does political uncertainty affect market volatility? Does the market prefer one political party over the other? Again, very common question that we get. What's the impact of the election on the stock market, maybe more specifically related to different investments or different sectors? And then lastly, and I think probably one of the most important questions will be, do you need to be changing your investment strategy during an election year, or do you need to be updating your financial plan based upon what might happen in the election year? And with that, I'm going to go ahead and turn the time over to Josh here for a few moments. And so Josh, let's go ahead and walk through this first question. How does the election affect the stock market?
Yeah, thanks for having me, Kyle. I think this is a really good question that I think everyone has on their mind, as you mentioned beforehand. I mean, over the last couple of months, I periodically get one-on-ones of people kind of considering or wondering kind of how they're invested, as well as kind of what's going on with the market when it comes to the election years. And what we wanted to show here is really just looking back at the last 10 elections since 1980 of how the election process has worked with the market, specifically the S&P 500 price index. So what we have here is the last, again, 10 elections. And what we can see from this chart or this graph is look at where all the lines are going, right? A majority of them are being somewhat stagnant, somewhat variation a little bit, but there's only two outliers really when it comes to this. We can see those colors are the light blue and the more of the maroon orange color. We can see that there was a negative correlation there compared to everything else. Well, the reason for that, those 2 years were 2000 and 2008. Those were things happening outside of the election during that time. Every other year, it seems like it hasn't really changed too much. So it's really important here that the election hasn't affected the market as much. It's more those other economic factors within. Another great question I think we always get is, we're looking at, yes, 100 days prior and post-election, but why don't we look at maybe the next couple of years of what elections really mean to us? So when we go through this next slide, we're going to look at actually again, the minimum, maximum returns, and average returns for post-election, pre-midterm, post-midterm, and pre-election. So those 4 years of the election process, of course, or when a president is in office. What we see here, and this is what's called I think it's called presidential election cycle theory. Some of you may have heard of this before, but what we want to focus in on this slide is looking at those average returns. First year, 8.3%. Second year, 4.2%. Third year is 14.7%. And then the last year 4, is 9.1%. Now, the two key things to focus in on here is probably that year 2 and year 3. We can see that year 2 actually has the lowest return, while year 3 has the highest return on it. Now, why is that? Again, this is just kind of more of a theory based, but those first 2 years in office when the president's in there, what are they doing? They're trying to maybe make some promises or go through Congress with some bills, whatever it might be, where they're not maybe focusing on the economy as much. Whereas year three, what's happening? Maybe they're gearing up for that next election. So maybe there's some boosts into the economy at that time. Again, this is more of a theory based on it. This is based off the last, I believe, 18 elections. So it's really interesting to kind of see that, how this is always a common trend of year two is the lowest average return, year three has been the highest average return.
Excellent, great. Thank you, Josh. And I think, you know, a couple of the other things that stand out to me on these first two slides is the market doesn't like that uncertainty. And as we get to the election, we see that volatility minimize quite a bit. And then on this particular chart, right before in year four, that pre-election, that's when we see potentially what's going to be the most volatile period of time. And I think what happens is that investors do tend to look at that volatility. And while, yes, we are going to see some of those fluctuations in account balances or individual investments, it's really important that we do keep perspective on that. And you hear this all the time of the importance of kind of riding out some of the volatility and making sure that we stay objective and that we maintain perspective. And so hopefully this helps you to see that we're kind of in that period right now where we are going to see that uptick in volatility. It's not necessarily a negative thing. We're just trying to get back to that point where we do have some certainty again, that we do know what's going to happen from an overall kind of political standpoint, but it doesn't necessarily mean that we need to make a large change to our strategy or a large change to our plan. We just need to keep perspective of that. Now, as we continue to move on here, I think that there's a lot of questions that come up around the idea of whether or not the market prefers one political party over the other. And I think that this chart, this graph from Fidelity gives a really good idea as to how you need to approach this based upon who's going to be in office. And again, the goal here is we're trying to remain objective and really just looking at what the historical data tells us. So on the left-hand side, if we were to see a Democratic president, and let me also preface by saying that we're looking at the average annual performance of the S&P 500 dating all the way back to 1933. So now going back to that left-hand side, if you have a Democratic president and a Democratic Congress, your annual rate of return would be somewhere around 9%. Now, if you move over to a Republican Congress with a Democratic president, we're at 13%. Now, if you go to the middle, what's interesting here is that if we do have a Democratic president with a divided Congress, annual rate of return is at 13.6%. Now, switching gears, if we move over to the right-hand side, Republican president with a Democratic Congress, annual rate of return 4.9%. If we had a Republican president with a Republican Congress, 12.9%. But then once again, when we do have that divided Congress with a Republican president, we're upwards of about 13.7% in terms of an annual return. So in some aspects, having that balance, and in some cases, maybe even some of that government gridlock, what it does is it helps to create less policy uncertainty. So this should hopefully help you to see that it's not that the market favors one political party over the other. In fact, the market is nonpartisan, and you can see that here, that there really isn't a bias towards one political party or the other. Now, moving on, we're essentially answering kind of the same question, looking at political parties and market performance. So the first chart on the left-hand side, this is a hypothetical example of growth of $10,000 dating all the way back to 1961. And if you only invested when a Republican was in office, that money would have grown to just over $102,000. That middle bar there, if you only invested when a Democrat was in office or the president, now you're slightly over $500,000. But if you remained invested, regardless of which political party was in office or president, you would have over $5 million. So the point here really is to emphasize the importance of staying the course and not letting our emotions get too much in the way when it comes to what's happening in terms of politics and remaining invested. And then the other chart, this is another great example here. We're looking at the hypothetical growth of a $1,000 investment in the S&P 500 index. This highlights a little bit more about Democratic presidency versus Republican presidency. You're starting with that $1,000 all the way back to 1933. So we have over 90 years of historical data to show that there are going to be some peaks and valleys as your money is growing with both political parties, but ultimately that $1,000 would have grown to well over $10 million. So the point here, kind of one of the main takeaways, is the importance of trying to stay the course. Now, that doesn't necessarily mean that we don't need to be making adjustments to our investment strategy along the way. But once again, when we start to speculate and when we start to make decisions based upon the data, not data necessarily, but opinions that are out there and maybe what we're seeing in the news and in the media, we've got to be really careful and make sure that we kind of keep that firm foundation with the way that we're managing and investing our money. Now, we've got one other way that we want to kind of look at this question of which political party might be favored, and we've kind of already answered that. But Josh, I'm going to turn it back to you for a minute here. Can you kind of walk through this graph and help everyone to kind of understand and see what this graph's telling?
Yeah, no, I think this is really important to kind of just analyze again. Going back to your prior slide, it really is important, again, just to stay invested, stay consistent, be comfortable with your investment strategy and throughout. And, going into this election, again, regardless of who takes the office, it's really important to kind of just look at, again, this historical view on it. And these are just the last 4 administrations that we're looking at here, from Bush, Obama, Trump, and then Biden. And what we see here is the percentages which people are rating the national economy as good or excellent. So as we can see here, for the Bush administration, we can see a majority is more red, or the red bar is a little bit higher than the blue. No surprise there with a Republican in the office. And then as we can see, when Obama took over in 2008, it flips, right? We can see that the blue bar is above, and more people that are leaning Democratic are thinking that the economy is in better or good condition. And then we can see another flip after Trump takes over. And again, that flip does happen again with Biden. So that's just one of those interesting things, of course, of whoever's in office. Looks like the leading party will think that the economy is doing better than maybe expected. The other thing I think is really important here is looking at the S&P 500 return at the very bottom. We see at the Bush, it averaged about 4.5%. Obama was 16.3, Trump 16, and Biden 12. Again, I wish this was showing a little bit more different election years or different administrations, but I think the moral of the story here is really, it doesn't really matter which political party we're under. A lot of the times, or majority of the time, we're going to have a higher return. Majority of the times, the average annual return is going to be positive.
Great, thank you for that, Josh. And again, I think I'll just reiterate here, just like we see here on this slide, we don't want to let our feelings and our emotions overrule how we're going to be kind of planning and how we're going to be managing the money, because potentially we could be leaving a lot of money on the table if we decide to go ultra conservative or go into cash. It really could jeopardize our ability to stay on track to reach those individual goals that all of you have set for yourselves. Now, the next question we're going to look at here, this is a little bit of a different take now on the impact of the election on the stock market. because we've talked about a lot of historical data. We've talked about understanding market volatility and how it's correlated to the election year. This is to help you to see whether we're leaning more towards a red wave versus a blue wave, some of the different sectors or stocks that we might see more of a significant change. So if we were to go on the left-hand side here, the potential beneficiaries of a red wave would be things like banks and financials, weaker regulation, lower capital requirements for banks. We have aerospace and defense to have a proposed increase in spending, healthcare, oil and gas. Now on the flip side, if we were to lean more towards a blue wave, now those beneficiaries are going to be industries and sectors like renewable energy, electric vehicles, telecommunications, home builders, industrials, and then tech and manufacturing. So what's the takeaway here from this? Once again, I think for the large majority of folks, I think that we're not necessarily trying to place bets on sector performance, right? We're not trying to speculate by saying, if this person is in office, then I'm going to take my money and I'm going to double down in this sector or that sector. But it does help you to see, and we're going to talk about this here in just a moment, the importance of having a well-diversified portfolio, meaning that we don't want to be overly concentrated in one individual sector or one individual stock. And I know for a lot of you, you've already sat down and talked to our educators and your advisors, and so you've already selected those investments that get you there already, right? You've got the right asset allocation, you have diversified that money, but just understand that one of the best ways, regardless of whether we lean right, or I should say red or blue, the importance here is to make sure that we continue to have that well-diversified investment portfolio. And so Josh, I'll let you kind of walk through this first part of this question, and then I'll add in a few other things. But I think that the main question that I think you get, that I know that I get all the time, is, do I need to be making any changes right now? So do you want to kind of walk through what folks should be doing right now, especially as we get really close to the election?
Yeah, no, and I think you did a good job of a high-level summary on it. And I think comfortability is key here when it comes to investment strategy, and at least understanding what you're invested in, of course. So obviously we want to review our asset allocation, really understand where our investments are going, what sectors are they in, does it make sense for us, and we really want to make sure that we have a very simple understanding of that. And for those who do work with an advisor or with a consultant of some sort, including our team, we just want to make sure everyone is well aware of what they're doing, make sure they're comfortable with it, make sure it's aligned with their goals, of course. And a lot of times this is more of a long-term perspective of things. I showed you, 100 days prior, 100 days post-election, or the 4 years of the kind of the electoral process. But again, a lot of you may be thinking about retirement planning or financial planning or whatever it might be that supersedes, a 4-year election window or an election year itself. So it's just really important to kind of keep that mindset of, again, what's my overall goal? Let's make sure we're consistent with it, comfortable with it, so we can be happy with whatever we're selecting.
Great points, Josh. And the other piece that I want to add to, I don't want to give the impression that we necessarily want to ignore what's going on. Like we've said throughout, we need to keep perspective. But what I do think is very important, up until this point, we've kind of focused more on historical data with market performance, investment strategy, and that kind of gets us to where we're at right now. What we don't want to lose sight of, and Josh already alluded to a couple great points, and I'll just expand a little bit on that, is we have to look at our broader financial planning as well. And so as we start to look at some of the different policy changes that are going to inevitably take effect to one extent or another, this is where we want to make sure that we're aware and mindful of that. What's happening in terms of tax policy? What is going to be going on in terms of government spending? What might happen in terms of healthcare policy? How could that impact Medicare or your ability to cover your medical expenses in retirement? Think also about Social Security and just retirement in general. You know, we've seen different changes that have taken place with required minimum distributions and things like that. So these are all things that are very relevant. And again, while you may not be able to ultimately control what that policy says or does, we need to make sure that we're aware of those changes so that we can start to look more specifically at how is that going to impact us and what are some potential changes that we might need to make. Because really your investment strategy is part of your broader financial plan. And Josh mentioned it, he alluded to it, especially for those of you that are getting closer to that age of retirement, or you're starting to make maybe that transition within the next 3 to 5 years. Things like healthcare and Social Security, even tax policy for that matter, become more important once you've retired and now you're living off of a fixed income and you don't have those paychecks coming in. And so as we start to see some of these changes, and as I know many of you know, we will definitely help to keep you in the loop as we start to see some of these different changes that are going to start to take place. Now, the last point that I'd like to emphasize here is, rather than just saying, I need to change my investment strategy, or do I need to change it? Take a step back and think a little bit broader. And I want you to ask yourself questions like, what are your financial goals? Are you on track to reach those financial goals? And has there been a big change to your plans for retirement? Are you at that point where you're ready to transition into retirement and you haven't put together your retirement income plan yet, or you don't really know where's the money coming from? How much am I going to get from my different accounts? How much am I going to get from Social Security? Do you have the right risk tolerance, or does your risk tolerance is it reflected in the investment strategy that you have? These are the kinds of questions that really get the conversation started. And so, as you know, we're here to help any of you, regardless of where you're at, whatever you've heard in terms of kind of this election year, or how you might need to make adjustments to your 401k account or just your investment strategy in general. We're here to help you with that. If you just scan that QR code right there, you can set up a time to talk to one of our financial education consultants. This is complimentary, so be sure to take advantage of that. And then as information continues to start to come out there, feel free to reach out to us. We're here to help you to navigate through these things. And you know, I think that this is kind of a great stopping point for today. But again, if you have additional questions, be sure to reach out to us. We're more than happy to help with you. As we move into the last quarter of the year, we are going to continue to have our monthly webinar sessions. For next month, we're going to be talking about renting versus buying. I know with interest rates and real estate costs, this is another hot topic that a lot of folks are wrestling with right now. So be sure to register for next month's webinar if you haven't already. We will also be sending a follow-up email, and the follow-up email is going to have a link to this recording. So if you want to go back and re-listen to it or share it with one of your friends or colleagues, feel free to do so. So just keep an eye out for that email. And with that, I just want to thank you all for spending a little bit of time here with us today. As always, best of luck to you. We're here to help any way that we can, and have a wonderful rest of your day. Bye-bye.